Well, stocks dropped today, comes ahead of tomorrow's big Fed decision. The central bank not expected to make any move on Wednesday, but our next guest does think there may still be at least 3 cuts on the table this year. Let's welcome Wells Fargo's Mike Schumacher. He's head of macro strategy. Michael, great to have you with us. You say 2 is in your forecasts?
I think that's right, Melissa, but it's interesting at this point. The inflation data simply have to turn. If they don't, 0 is the number. If they do, could be 3, could be more. But it's almost a bimodal type of thing right now. There's not a happy middle ground for the Fed.
Is hike going to be anywhere on the table, do you think?
Ooh, it's a pretty high bar for a hike. Talked to a lot of clients over the last few weeks, and a lot of people are saying, you know what, maybe a hard landing's a lot more likely than we thought a month ago. But a hike, that seems like a real stretch. So I suspect that'll be put off quite a bit. At
what point, I mean, how many sets of data, how many months of data do we need to see where an inflationary trend is established as opposed to the inflation coming down as we've seen? I mean, it was how many months to establish that trend? Is it going to be?
Well, it's three bad CPIs in a row.
Right, exactly.
Right?
So is that a trend or no?
It's hard to say it isn't. And you can at least make the case inflation's become essentially stuck. So you're not getting a lot of progress at this point for the Fed. That's a tough thing. Does the Fed need to see a couple more bad prints and say we just got this one wrong again? Maybe. But I suspect it's going to hold out and just hope things get a little bit better and not jump the gun quite yet.
So, Michael, let's play this then into just interest rates overall, because there's a difference between inflation and rising rates, right? And this gets into some of the quarterly refunding dynamics. This gets into technical aspects of the market. This gets into foreign central banks maybe not being as active as they might. And ultimately, this makes, it's a financial conditions dynamic that the Fed also wants to think about. Maybe they actually want things a little tighter anyway. But let's talk about rising rates, because rates are moving higher, and it's not necessarily inflation to me. I mean, maybe Fed expectations, seemingly should be at the short end of the curve. Let's stay to the long end of the curve, where rates seem to be wanting to go higher. Talk about that. Talk about quarterly refunding. Talk about your view there, because the trend isn't good either.
Yeah, a lot of good points there, Tim. When you think about nominal rates, you want to break them down into 2 pieces, the inflation component and the real yield. Real yields have gone up a lot this year. Inflation expectations have only started to pick up steam in the last month and a half. So I think you're right. The inflation side has been lagging a bit. People in the market have said, inflation didn't really move much for a while with respect to expectations. Why should we de-anchor now? But when you see 2, 3 bad CPIs and a bad ECI, eventually people in the market say, can't really go against that. So we will price up inflation. But we do think that the big move, if there is another leg up in rates, is probably in reals, not so much in inflation expectations.
So, sorry, lost my train of thought there for a second. If it's not about real interest rates, then what do you think about this dynamic you touched on a little bit of the quarterly funding and what's coming up and how that's going to be received, and what will that make a difference to the market?
This one should be fairly tame, Karen. The last few have been market movers, to be sure. But the thing is, Treasury's indicated pretty clearly it's about done with increases for now in supply. So you have to wait until next year, probably after the elections, after we get a new Congress, in particular if there's a sweep. It almost doesn't matter if it's Republicans or Democrats sweeping. The way we look at it at Wells Fargo, either way, they'll spend more money. They might spend it differently, but more spending, bigger deficits, more supply, bad for bonds. So that's the thing to watch. But tomorrow should be fairly calm, we think, at least as far as refunding goes.
Last quick question. More likely to have a soft landing or a hard landing at this point?
Soft landing, but just by a little bit. Hard landing's creeping up in terms of probability.